Annual 2025 recap of, a really crazy year. What a year it's been so far.
And I mean, if you're, serious about getting into investing, these are the things that you have to be looking at, the KPIs of the economy and what's going on, what things actually impact your ability to invest, especially for the commercial guys that are getting into, CMHC and you're dealing with the CMBs. Your whole project is based on something that, is quite variable throughout the time up until you close.
Yeah, macroeconomics. Like, it's your mortgage broker at this level isn't just checking the rates online. Like, we're taking a look at all the different aspects of what's happening, projections. It's quite a bit more complicated than just taking a look at what the rate is.
I mean, the most popular strategy on the mid-size, and even some of the larger size, investors is still
Purpose-built rental housing starts have skyrocketed. So you have a massive amount of housing, and I think CMHC being the only game in town is pumping the brakes. So like we either have way too much exposure or there's too much risk, and we want people to maybe go find alternative avenues to do it. And as you said, okay, guys, we are back for another episode of the BLD Financial Podcast. This is a special podcast. This is a annual 2025 recap of a really crazy year. What a year it's been so far. 2025. The year of volatility, massive changes in markets. I think a lot of investors are going to remember this year as one that's not forgettable.
Yeah, I mean, the amount of, you just take a look at like the bonds, the CMBs, how much of a swing we've had this year, just like, total gross swing from highest to lowest points of the year. It's probably like 60-ish basis points, maybe a little bit higher, maybe a little bit less, give or take. But, that's been interesting. Lots of back and forth on projects where clients didn't have to have buy downs. Clients did have to have buy downs. Some more CMHC changes that came in this year, which honestly isn't even a surprise anymore. It's really just more of like your everyday situation with CMHC, but some more of that stuff to deal with. Market changes a little bit in terms of, real estate prices kind of down, volume overall. I don't know. Some say it might be up a little bit.
Year over year, yeah.
Year over year, maybe more on the res side. I think the commercial side still has been pretty steady. Construction starts on the mid-rise stuff are up, maybe not on the larger rise. High-rise stuff, condo developments obviously still struggling, but interesting year for sure.
Yeah, volatility and stability, all at the same time. Volatility coming down to stability. I think we're at the end of 2025, and we have at least some stability in markets. We're seeing, as you said, bond yields are kind of stabilizing out and moving lower. Prices are stabilizing out. I think everyone's kind of figuring out what the new norm is and how we're going to move forward, which is kind of a blessing and a curse. We at least know what baseline is and we can move forward.
Baseline is chaos.
Yeah. 2025 was a big year for us as a company as a whole. BLD Financial, we launched, we were able to help a ton of clients across the country build, develop, acquire, construct, navigate. If any of our clients are listening, we truly appreciate you. This is without you guys, we wouldn't be able to do anything like this. So, big year for BLD. We have a lot of plans to continue to help the market next year. So, really appreciate all the opportunity available out there to be able to help investors and developers navigate.
Yeah, absolutely.
2025 market recap. I mean, we touched on it a little bit. Where rates ended, where they started. So we are currently in September at the moment. So the last quarter of the year, and the bond yields are reacting to economic data that's coming out that is much harsher than initially anticipated. So CPI numbers are still running hot. We have job losses that are far exceeding expectations across the board, both in Canada and the United States. And policy decisions are starting to be projected and crafted in a much more serious way than we've seen from the rhetoric from the Bank of Canada previously. As of today, I believe the Fed is projecting three or four cuts for the end of the year, possibly.
Yeah.
And Canada, some rhetoric around a few cuts before the end of the year, and possibly even some next year. So, things are shifting pretty quickly on the rate side at the moment.
Yeah, I think, you take a look at, both Canada economy and the US economy, all the data points you just went over, job loss, unemployment, inflation, like, it really all points to one thing, which is just a reduction in rates. Even in Canada with housing numbers still being low, the only thing that's really going to help to trigger that is some sort of reduction in costs overall. Rates being the easiest one. We're seeing some movement on, DC fees. I think Brampton actually just came out this morning and said they're bringing DCs down 100%, I believe it was.
Wow.
So I mean, but really the big thing is obviously interest rates. The DCs and stuff are nice, but the interest rates are going to be the biggest push to get guys moving again on the purpose-built rental side. So I think they're estimating maybe a point in the overnight rate decrease by mid next year, from end of 2025 going into mid 2026 for Canada. And that's something going to be more prevalent if the Fed does drop every single policy announcement. We can't afford to fall any more behind in terms of just like the value of the Canadian dollar to begin with. I think it's, as much as there are some people who are still kind of bearish on Canada real estate, I think definitely on the mid-level size, like the interest rates drops are definitely going to push more people to start trading more assets and getting into more mid-sized builds.
I think it's important for people to understand the impact of like a significant impact to bond yields and what it does to borrowing power. We sit here and we talk about 25 basis points, 50 basis points on the overnight lending rate, and that is quite impactful, from a borrowing cost perspective. But that's really only as variable debt. That's construction debt. That's HELOC debt. That's debt that investors use and utilize to be able to construct and build and move capital around. So freeing up that capital will inevitably provide movement in the market, but the larger impact overall are the bond yields. If we start to have a 25 basis point difference in bond yields is the difference between a project working and not working. And over the last even 2-3 weeks from when we shot this podcast, we've seen massive changes in those bond yields. And you can quite literally feel the calls from people calling because they know that the financing now works. Like, it's the difference between 25% down and you being able to use the 15% down, or like not having to submit at an incredibly low max rate to get deals done. Like, the lower the carrying cost, the more active capital is going to be, and we're just seeing it in real time right now. So I think moving into 2026 and the end of 2025, if we continue this decrease in these rates, I think you start to see some sideline capital, start to take a look at these buildings now that are on the market that are now opportunities. Realistically, anyone who's selling in today's market doesn't want to sell their property. They're not getting top dollar.
Yeah.
There's a lot of inventory in the market, so it is bringing opportunities for these mid-level guys to go in and acquire with decent financing on the buy.
Yeah, and I mean the most popular strategy on the mid-size, and even some of the larger size, investors, is still leverage. So, when you're taking a look at, like you said, like, even 10, 15 basis points on the bonds is a huge deal in affordability. Even just from, you take a look at situations where there's buy downs, like 5, 10 basis points, 15 basis points, you're talking, hundreds of thousands, high tens of thousands, 80, 90 to, even $1 million on some of these larger projects. That could be a 10 basis point, overage on your ceiling rate. So, even on the higher end side, like just any sort of movement obviously is going to help, put more money back in your pocket as well too on, any situation where there's buy downs. Definitely going to help on projecting some of these projects moving forward for construction, where you're 12 to 18 months out from your construction takeout or your term rates. So I think obviously we're running the end interest rates or the project qualification. We're not basing that on the variable debt. It's going to be based on the bonds. So anytime we can project lower, I think it's going to get more people in because they're projecting lower. Obviously, it's when you start to look at construction projects, like, I guess there is some caution to have there where, you don't want to start being too aggressive saying, hey, like rates are falling. We're going to predict another 50 basis points fall by next year. That's where we're underwriting our rates at. You still want to be relatively conservative, but from an affordability standpoint, at least, the rates decreasing is a good sign.
The markets always come back to equilibrium. Like you see high vacancy, you see lower rents, and then, to be able to bring that back, you need to have lower carrying cost of capital. And that's kind of what's happening in real time right now is economy, those are precursors to bad economic data, which then causes the effect of, lower interest rates, which decreases the carrying cost and everything kind of stabilizes back out. Yeah, interesting. The opportunities are absolutely there.
Well, I think even for people like who are, if you're about to rate lock or you're coming into your refinance, like starting to understand the key like economic indicators that are coming up, like when are U.S. announcements for rate policy decisions, job loss, inflationary numbers? When are Canada's job loss, inflationary numbers? What are these key dates, and how close is your potential closing or refinance or whatever it is, to these dates? And if it's, a day or two after where you're supposed to be rate locking, I mean, it's up to you, and you can have that discussion with us or your broker. But, maybe, you take a look and see like, hey, like things are looking like, rates might be coming down afterwards because job loss is actually going to be projected to be, I think we were like 20,000 over what the projected was, right? So, I mean, like if you're that close and you're that, you have the ability to kind of play with those numbers, you look into that. Or, if the job loss numbers are coming up before your closing date, hey, maybe you try to like lock in a couple of days before, right? I mean, these are things that you can at least just start to utilize and try to make better decisions and at least be aware of it instead of having, just kind of like an out of the blue conversation with your broker. And then there's a conversation of a rate buy down, right? Like at least try to be as aware as you can. And I mean, if you're, serious about getting into investing, these are the things that you have to be looking at anyways, is the KPIs of the economy and what's going on, what things actually impact your ability to invest. Because, especially for the commercial guys that are getting into, CMHC and you're dealing with the CMBs, your whole project is based on something that, is quite variable throughout the time up until you close.
Yeah, macroeconomics, like it's your mortgage broker at this level isn't just checking the rates online. Like we're taking a look at all the different aspects of what's happening, projections. It's quite a bit more complicated than just taking a look at what the rate is. Let's talk about capital markets. The capital markets, obviously, capital in general either tightens or expands and is more freely flows based off of the economy. Obviously, conventional financing is tightened up to the latter part of 2025. Underwriting has become tougher. Lenders are becoming maybe more I would say scrutinizing, but like they're digging into things a little bit more than they probably were previously. Conventional. There's still a lot of capital in the market for good borrowers that are well capitalized. If you have lots of experience and you can find a good deal, the banks are still more than willing to be able to give you capital. On the construction side, things have definitely tightened up. I think this is where the majority of lenders saw a lot of losses over the last 12 months, either on land loans or on construction loans. People who maybe weren't as capitalized as they thought, or got caught with raising interest rates and couldn't get a high enough NOI and their debt was upside down. So we're definitely seeing more scrutiny in like the liquidity requirements from conventional banks. They're not necessarily even wanting to do like smaller loans just because of the risk associated with it as a whole. Larger loans, again, good borrowers, there's still lots of money. CMHC capital is still widely and readily available as long as you can, qualify. They are moving away from maybe secondary markets on construction loans. The market is shifting to offset that risk. Private lenders are even, still are underwriting like conventional lenders at the moment. They're more or less no longer equity lenders and more debt servicing and personal qualification, which is interesting. But I think everybody's just pricing at risk at the moment, maybe bracing for impact, dealing with the defaults they have, but still open for a deal that still makes sense.
Yeah, I mean, land is
impossible.
Pretty like, yeah, if you're not, central in a very major market at a very conservative value, at a very conservative loan to value, Site serviced, ready to go, experience, liquidity. Built-in interest reserves are almost impossible to get. They want you to be able to carry the debt. Equity takeouts, what is it going to? Why do you need it? Like, it's very challenging on the land side. And obviously the land market's been hammered over the last like year and a half, 2 years. Like lenders, I think like just from a borrower standpoint, like understanding how lenders are looking at situations, like they're trying to assess a deal as quickly as they can, right? So they're going to go through some benchmarks, and one of the things they do look at is loan size, right? Larger loan sizes tend to equal better borrowers, just because you have to have more liquidity, more net worth, more experience. Lower loan sizes tend to equal more risk, just because it tends to be newer investors who tend to have less money, experience, and net worth, and that's just how they look at it. That's why in the past, construction financing, especially with CMHC, is typically like 10 million and above. It's moved a little bit now. You can get that 5 to 8 million done relatively easy in good areas with strong projects with CMHC. Under the 5 million is still a bit of a challenge. But that's kind of how it's always been. And that's how they're looking at the projects. If you're not going to CMHC on the construction side, if you're going with like a credit union, just understand that even if the credit union can submit to CMHC, they're going to make sure the CMHC exit works, but they're underwriting your construction loan on non-insured debt. So, can you debt service at 1.2 with like a mid-5 interest rate and a 30-year AM, which is definitely not going to be as competitive as your CMHC debt. So, be prepared to get 65% loan to cost, maybe 70% loan to cost on most projects, because that's just where they're underwriting at. If you don't want to go private, that's kind of what you're dealing with. And again, it's that's just how they underwrite. They're taking a look at that economic factors, right? They see that vacancies are up, so they're factoring that in. They know rents have softened, so they're going to drop your performer rents by $100-$150 if they see fit. And that's not saying you couldn't still get those rents if you have a really good team, or if you really believe you're going to get those rents. It's just the lender's going to take those precautions and make sure that they're not underwriting an overly aggressive project when that's what they're seeing in the market today on the projects that they're building or refinancing.
Yeah, and it's important to understand, like, all the projects that they were doing 2 years ago, they got caught with higher interest rates than what they underwrote the debt at. So everyone's gun shy at the moment because all the numbers were way off, and they're dealing with the ramifications of those at the moment. So even though we do have bond yields coming down, I very much doubt they're going to be quick to bring that underwriting down.
They never, like, banks are never really quick to move and make anything easier. So I think like it's going to be, I think it's going to get more challenging in a sense, even though the rates are coming down. I think, CMHC increased their insurance premiums on CMHC, like specific construction financing. It's like 85 basis points higher, I think, than the what your term takeout financing would be. I think you're going to see probably some people maybe move away from CMHC construction financing, going semi-private or, credit union, bank, whatever, and then going back in. I think, just that increase of people moving away from CMHC, even if it's only 20% of applications, whatever, like, it's just more, potential qualified individuals moving into the non-insured space. When you get more of anyone going into a space, lenders are definitely going to be, a bit more picky choose. They're going to have the ability to pick the best applications, right? So it is going to make it a little bit more, difficult for some individuals to get financing potentially. So just keep that in mind. And just because we need more housing in Canada doesn't mean the lenders are going to make it easier to get construction financing. It's just not how it works. They're going to structure their underwriting based off economic factors and what they're seeing, and not necessarily just because, it's an important topic that we need to have more of in Canada.
Yeah, I think that's a decent segue into our favorite topic, which is CMHC changes in 2025. I think every single year, thank God, we get a lot of content to be able to shoot out of it. But every year, every like 4 months, without fail, there's something changes fundamentally, and all investors need to pivot and find a way to be able to work within the guidelines that CMHC now allows for construction or like takeout financing. And as you said, some of these policy changes, like the increased insurance premiums, from an underwriting perspective, doesn't impactfully change anything. But from like a cash flow perspective and cost perspective, it's a way for them to be able to slow down what's happening right now. If anyone has seen any data coming out, purpose-built rental housing starts have skyrocketed. And they skyrocketed last year and the year before because all these condo developers who had land had to move the land because they had very expensive debt on it and they couldn't pre-sell any condos. So they had to switch to purpose-built rentals and use the CMHC program, which had the smallest amount of equity possible to build these things. So you have a massive amount of housing. And I think CMHC, being the only game in town, is pumping the brakes. So like we either have way too much exposure or there's too much risk. And we want people to maybe, go find alternative avenues to do it. And as you said, even 20% of the applications would make a difference. The insurance premium increases are all based on sliding scale of leverage and amortization. And most, I think, of the people who are using it of default were trying to get the maximum leverage. And that leverage, I think, is where they're trying to push applications away. So I think as a whole, that was probably a good move. It doesn't make things necessarily better for the average investor, but from like a de-risking perspective, I think it was a good move by CMHC.
I think the president of CMHC early this year or late last year, I know like one of the conferences, I think she made it really obvious that they would prefer to be able to deleverage their risk. I mean, I think they know that, or at least I hope they understand that, CMHC, I'm sure they see the numbers, right? Like it was like 90 to 95% of like new construction starts are CMHC right now. They must know that they are an important piece of the puzzle when it comes to new development and just trading of assets in general. I get obviously wanting to deleverage, and I mean, as CMHC is an insurance company or acting as an insurance company, like I definitely understand that. So I mean, I get that. How they go about it, I don't necessarily know. Do they make the program more strict? I think it's pretty much as like I don't know how they'd make it much more strict. Like the affordability is pretty tough in Ontario. Yeah, I mean, they've made a lot of changes to accessibility. Energy efficiency has already been cut in half. I mean, it's already, in a sense, like relatively difficult to make work in certain markets. I do think CMHC is, I guess, contrary to what I said about people moving away, I think because of all the insurance premium or just, policy changes, I think there are some people that are preferring to do direct construction with them just to be able to get their construction applications in and just ensure they're not getting kind of beat by any policy changes. So I think, there might be a bit of a tick there, but, CMHC can't go away in my eyes, unfortunately. Like that's just the program that's kind of saving the market right now.
We made our bed. I mean, we have to deal with it.
Yeah. Not a lot of the large developers are making, as big of moves or as much of a volume move that they used to make. They're either still figuring out what their condo development project should do or needs to do, and they're sitting on that, or they're just, sitting on the market and waiting for the right opportunities. It's the mid-level guys, like this more private sector, that's really taking on the burden of it. There is a lot more leverage and borrowing of private debt on the middle side. Therefore, you need more leverage, and the CMHC program is just, it's going to be utilized because that's what's needed. That's what makes the most amount of sense. It allows people to scale appropriately at a relatively efficient cost. It's your cheapest debt on the market. It's definitely your cheapest construction debt. So yeah, I think, I don't know what else CMHC does in terms of wanting to deleverage. Maybe, like we're already seeing smaller markets or less populated markets, regardless of loan size, it just seems to be of no. I've had a few projects this year where, even though it was the fourth largest city in a province, 25, 30,000 population, like it was just, all the lenders were saying no to direct CMHC on, $20, $30 million worth of like CMHC construction debt. So, it was just, they just weren't interested in it.
I find that the risk is also different on a construction loan versus takeout as well, though.
Oh, for sure.
Yeah, if your secondary markets on construction loan is increasingly difficult in 2025, and we're probably going to continue to see that as like the credit teams at individual places, are assessing and managing their capital for like risk, because the COI you can get, like, a lot of people don't understand that you can go through CMHC and get the COI, but like if the actual lender doesn't have the appetite for the deal, it just doesn't get done.
Yeah.
Which is an interesting dynamic. I actually had a guy call me yesterday asking about how that works. He thought like once you get the COI, it's set in stone. That's it. That's game over. Nothing changes. And unfortunately, market dynamics kind of change
Yeah,
that.
yeah, and until it's funded, like, if there's key changes or review of the project afterwards, like with credit. I mean, yeah, they don't, the lender definitely reserves the right to not follow through with it. Unfortunately, I mean, that's why the LOIs are, not set in stone, and they're, it's good to have, but it's not, it's definitely not like a concrete condition of financing, unfortunately. So,
Yeah. Well, what do we see in 2026 for CMHC? I think obviously the merry-go-round continues. I think as rates come down, if they come down in a meaningful, impactful way on the uninsured side, I think people start to move away from CMHC to offset the taking on insurance premiums if the rates can get low enough on an uninsured financing. I think that what's worked so far this year is missing middle housing, and I think that is going to be CMA is going to have a huge part with CMHC as they continue to scale that. As a whole, I don't see necessarily a change with CMHC as like a staple in the financing sector, the multifamily side next year. It's just going to continue to
no.
grow. Maybe just another reassessment of risk and where they're at,
Yeah.
and if there's any kind of holes in any programs.
I think like Canadian investors hold on to things, really tightly. Like, even look at today's like just interest rates from, even just on the residential side for home buyers, like, you can get low threes on an insured rate. People still want lower rates. They want the rates of, 2021 to, 22, those like sub two, sub 1% rates. I think now that people have already had the taste of CMHC, like that's going to be, expected forever. I think if, CMHC were to make a major change, like let's say they got rid of MLI Select, right? Like I think people would just, I think there'd be like an uproar where, investors feel like they're kind of entitled to have those programs, which I think like, I think you do need to help support them. I'm not saying like they don't deserve to have it, but I just think like it's just my point is that if I don't think CMHC is going to go anywhere in terms of like a demand for the product for sure. Whether CMHC makes those decisions on their own, I have no idea. But I don't see people ever going back to just trying to do everything with term debt on like non-insured side. I think there is a population of investors who just don't want to deal with CMHC. But on the mass scale of volume, I think like CMHC is always going to be in demand, and I don't see it going anywhere. Now that people have had a taste of really what it does.
Yeah, it's I agree. I think maybe one change they could implement is just a higher net worth requirement. The bar just creeps up slightly to be able to offset.
More emphasis on actual liquidity versus net worth. Yeah, I don't think they're going to be finished with policy changes. Like I'm sure we're always going to consistently have tweaks here and there. I think that's how they're gonna manage it. Like, and I think in the past too, they've used the policy changes to try to manage pipeline. Back when they were doing the private lender had to be on title for, was it 24 months?
Yeah.
They went from not having a 24-month policy to specific lenders having to be on title to, like 8 months later, all of a sudden they'll take out any private lender regardless of who they are or whether or not they're, approved with CMHC and how long they've been on title. So, I mean, like, in my opinion, that was, obviously they weren't really, making changes they thought were for the better because, they got even like more lenient on their policies at the end of it. I think it was just CMHC pipeline was crazy and they were kind of using that to help slow it down. So who knows?
Yeah. No. Well, it'll be there next year.
Yeah.
The 2025 brought a handful of really cool new investing strategies. Missing middle development blew up. It became what it is, at least today, in its infancy. Now that increased zoning and densification laws are automatically kind of being grandfathered in across major metropolitan areas, Toronto, you're seeing it happen in Hamilton, Kitchener. That missing middle housing, was kind of a way for the average retail investor to scale up into something that was bite-sized but still in the commercial space. We've seen massive growth in that. I think that lenders are starting to understand that this isn't just a fad, but an investment strategy out of necessity. Personal debt servicing is no longer working, and the majority of mid-sized, small-sized investors are going to be getting into this space. So, you're seeing more like events towards it. You're seeing more lenders kind of gear some of their financing tools towards it. I think it's cool to watch, mid-level densification and like the numbers actually start to work. Whereas like you couldn't buy anything small in GTA because there was no cash flow. So I think we see more of that, or like a larger emphasis on that, as the federal government keeps putting pressure on major municipalities to increase the densification and allow for more building and more units. And it was cool about this small stuff is, it looks nice too. Like it's not just like a box in the sky. Some of them are, a really nice architecture. People are taking their time and they're putting their own, flair to those developments. I'm excited to watch where that grows and see, how that's going to morph into something and kind of a new investment arm or tier. And what's cool is we're seeing people do it almost in an institutional way. Never am I having a conversation with one person saying like, I only want to do one. Everyone's like, oh, I want to, I think I can figure this out. I can do like, 4 or 5, and I like the specific area, and they care about the people in the area, and they care about like the growth of that area and the type of people, and they're having more sophisticated conversations. They're looking at transit. They're looking at new municipal laws that are coming into effect. So, looking into 2026, I think that's going to be big. I'm excited to see where all these mid-sized investors and developers go with it.
Yeah, I think, like you kind of touched on it there, but I think like missing middle it's more than just like, the affordability aspect of, the missing middle. I think it's also like the connecting piece. It's going to allow like neighborhoods to grow with densification, but not becoming just giant towers, right? Like you can't just start going in and throwing, 30-story towers in the middle of like random neighborhoods, or in these very like commercialized steel glass looking condo structures. Like I think, there is some importance to trying to keeping as much of like that neighborhood vibe as possible, as much as we need more densification, right? Do we want it to look like, kind of what's happening in China, where it's just skyscraper building steel, like no. So I think like missing middle is that bridge there where you're still getting the densification that you need, but you can like tailor the construction and the architect to at least fit into the, the neighborhoods. And it's important to have that. I mean, it's going to help, or should help at least, like kind of cut down on the NIMBYism, should help the cities be more, pro for these types of projects to be able to grow. Yeah, but yeah, I think you're right. Like I think there's going to be a continuance. There's going to be more of it. Probably more bylaw changes for zoning, maybe some more, maybe a specific product to it. I don't know what else you could really do to kind of, tailor a product more specific to the missing middle than what's kind of out there right now. But definitely more of the project for sure.
Yeah, and I think what you're also seeing is on the purpose-built multifamily side is mid-sized investors are in either disposing of assets, or they're like moving up to larger assets. They've realized that even the big guys are cycling out capital. A lot of these big funds, over the last 2, 3, 4 years, they've raised a ton of capital to go on a buying spree, but they also have massive redemptions now because you can only have capital for so long. So we're starting to see parts of portfolios of very large REITs and whatnot have to start disposing of assets, and you're having these mid-level guys catch kind of a perfect time where these other guys have to sell and they can buy, but bonds are coming down, and the programs are now set to do it. So you're also having a lot of conversations with just mid-level guys who are looking to make a move in the market. Most people who have gone through a cycle are situated for what's about to happen, and unfortunately, what's about to happen isn't comfortable for the country. We're not moving towards somewhere where it's going to be better in the next 12 months. We're moving somewhere it's going to be worse economically. You're going to have more vacancy and probably pressures on rents, but cap rates are expanding. So the opportunity or the opportunists in the market, at least in the mid-level size, they're sitting on capital or raising capital and finding good opportunities. So I think that's still something that we're looking forward to next year, is just like watching maybe some of these assets change hands and some of those opportunities that are going to come up. and maybe it allows anyone who's a smaller investor here to situate themselves to make a generational buy. Like if you can find a deal that the numbers actually quote unquote work again, you don't have 10 people overbidding on a purpose-built multifamily in a decent area, maybe you can get into something. So, having those conversations, I think 2026 is going to allow for those generational plays if you're well capitalized.
Yeah, I mean, I don't doubt that we go back. Like, I think, I mean, is it inevitable that as prices drop, cap rates expand, you start to get more, aggressive bidding on it? Like, I still think it's interesting. I was talking to like a realtor about this the other day, but just appraisers and how everything just comes in at the purchase price now. And I mean, what else do you do as an appraiser, right? I mean, unless the building really isn't worth the value, I'm not saying anyone's doing anything wrong or shady, whatever, but it's just interesting that everything just comes in at purchase price these days. Like there is no, I don't see any appraisals anymore where it's like, oh, I bought this for like, 500,000, under the value or, whatever, or it's overvalued, like whatever it is, right? Like you don't see it. Everything just is right to the amount of the dollar on the purchase price. And then it also just makes me wonder though, like, what does that do to like market comps and structures where everything, you just go buy a building, yep, building's worth this. Like it's just an interesting thought, I guess. Are you really creating like good market comps and data points, or is it just, hey, this is the agreed upon purchase. Yep, value came in, at purchase price. Okay, asset gets, kind of traded. But
yeah, I think unfortunately it's a justification, and the data points, the levers you can use. I'm not an appraiser, but the levers you can use to be able to determine different types of value. You have direct comparison approach, capitalization approach, sometimes cost approach. If there's data points on certain different approaches to be able to meet the target on the purchase price, absolutely, it's an interesting deeper conversation. Yeah. I think maybe with a realtor, but or an appraiser, but it is absolutely interesting. Moving forward to advice for 2026. If you guys are looking to acquire something, expect lower carrying cost on bridge debt as prime moves down. If you have a mortgage and your mortgage is coming up for renewal or the end of the term in the next 12 to 18 months, have an understanding that the policy rate decisions take about 12 to 18 months to filter through the market. And usually the reason why the Bank of Canada would increase rates is because to fight inflation levels. So, you have about a 12 to 18 month period when the rate cuts start to be able to, find some sort of bottom in the bond markets if you're going to move into a fixed rate mortgage. So, maybe strategizing on what does that look like for any mortgage that you have up right now, taking a look at stacking your debt or strategizing on restructuring that debt would be probably something to dive into in 2026. As a whole, like in investment strategies, I don't think people are slowing down. Just invest in like the people around you, like who's around you. Are they having these conversations about economic data? Or, do they have a finger on the pulse of the capital markets? What's happening? Does your realtor have access to on or off market opportunities? I think a lot of stuff is going to get traded off market in the next little bit. So, stay vigilant. I think there's still a ton going on.
Yeah, like good deals are always going to have, attraction to a lender. Just continue to grow your understanding of like we were talking about, like just like the KPIs of the economy, what to look out for. Real estate is still an investment game. You still have to understand how to read market cycles, the data points, when to get in, when to potentially exit, when to refinance. Obviously, there's differences in, Alberta markets, New Brunswick markets, BC markets, Ontario markets. Like certain markets are going to be able to fit, certain strategies potentially better. Keep connected to certain individuals in, the space, especially if you're on the development side, right? Finding good developers, good project managers, trades, guys like that as well too. Because I mean, as things start to get more busy, certain companies are going to get, more busy as well too. So trying to just build those relationships now before moving into the busier market and just having that, power team. It's always a conversation that's always been around as the power team talk, but, just continuing to grow that and picking the right pieces for your puzzle.
Yeah, guys, at BLD Financial, we're just focused on growing and helping our clients, giving you the best information available to be able to make an informed decision. We're going to continue to shoot content and create this value for you. If you guys obviously did like this and you like what you heard, feel free to reach out, either Aaron or myself. We're happy to have a more in-depth conversation with you about what our thoughts are on the market and maybe what your current situation. If you are listening to this, please give us a rating on whatever platform you're listening to us on, whether it's Apple Music, Spotify. It helps us reach more people. So really appreciate it, guys. We will see you next time.